Alright, so the current business landscape is witnessing an explosive trend that is polarizing opinions across the financial community, which is the resurgence of share buybacks. On one side, we have guys asserting that buybacks are an effective method for returning surplus cash to shareholders and boosting stock prices. Then, on the other hand, guys are arguing that this practice primarily benefits corporate executives, enabling the manipulation of key financial metrics while potentially undermining long-term corporate health. The discussion of who's right really depends on whether buybacks are a sustainable method of maintaining a company's value, and as we'll explore in today's video, this practice comes with a lot of caveats for both the investor and the stock market. So we'll take a look at what the exact situation is, the circumstances behind why this is happening as of late, and how rising interest rates could actually run certain companies into the ground if they're not careful. So, to find out why, make sure to stay tuned until the end of the video. Now, for some of you, you might be wondering what a buyback even is. Well, it's kind of what it sounds like, a company buying back its own shares, and when it does, it reduces the number of shares out there, or outstanding as the financial folk call it. This makes each share worth a slightly bigger piece of the company. It can make the company's profits look better on a per share basis, which is often how top bosses' bonuses are calculated. It also often boosts the share price, making the company look good in the short term, but beneath the surface, this practice might have some not so great effects. I guess in a way you can consider it as makeup for a company's financials. You know, it looks great, but you get to know it, it's not so charming. One of the biggest issues is that the money a company spends buying back its shares is money it's not investing in other things like coming up with new products, improving its equipment, or training its workers. You know, things that are kind of key for a company's long-term success. It's kind of like choosing to buy a car that you don't need only to have no money for rents. I mean, at the very least, I'd hope you bought an SUV so you could at least sleep in it. If not, I guess you weren't smart to begin with. Then there's the question of who really benefits from these buybacks. Well, let's take an example. Last year, the world's 1,200 biggest companies spent a record-breaking, and I hope you're sitting down, they spent $1.3 trillion buying back their own shares. But who got the lion's share of the benefits? You guessed it, the top bosses and some savvy short-term traders. Long-term shareholders, who are often smaller everyday investors, may not benefit as much. Instead, they're left holding the bag if the share price drops because the company didn't meet the expectations set by its artificially boosted earnings. Then, a particularly shady aspect of buybacks is their potential for misuse. Surprise, surprise, companies can be pretty shady. They can execute buybacks to artificially inflate earnings per share, or EPS, a crucial figure often tied to executive bonuses. Ewan Munro, CEO of Newton Investment Management, raised concerns about this very issue, arguing that buybacks can be used to manipulate EPS numbers upwards to meet management incentive targets. Here, the ethical conundrum is clear. Executives stand to gain personal wealth at the expense of long-term company health. That oddly rhymed, I'm proud of that. Just take the example of the oil sector, which in 2022 bought back $135 billion worth of shares, a staggering 4 times the figure from 2021. I mean, it's hard to argue that there were no better uses for this cash, like, I don't know, paying my college loans back, or investing in transitioning to renewable energy sources, considering the impending global shifts away from fossil fuels. Thankfully, some people in power are trying to rein this in. US President Joe Biden, for example, has introduced and is proposing to increase a tax on these buybacks. The Securities and Exchange Commission, the big US stock market watchdog, also wants companies to give more details about their buybacks. But there's been some pushback. Shocker, with some folks arguing that buybacks are crucial for healthy capital markets, yet it's crucial that the health of these markets don't rely on practices that could harm the long-term well-being of companies and widen wealth gaps. To be fair though, buybacks can sometimes be a good thing. If a company's shares are undervalued and the company genuinely has no better use for the extra cash, then a buyback can be beneficial. But it's just the growing scale and potential misuse of buybacks that's causing concern. Moreover, when interest rates climb as they currently are, the landscape of share buybacks can shift significantly. Companies often borrow to finance buybacks, so as interest rates rise, the cost of such borrowing also increases, potentially making buybacks less attractive due to the higher costs. Now, alongside this, other investments like bonds offer better returns, enticing companies to shift their cash there instead of towards buybacks. Plus, the discount rate, which is crucial in financial modeling to calculate the present value of future cash flows, is directly affected by interest rates. Higher interest rates also mean a higher discount rate, reducing the perceived present value of future earnings and potentially making stocks appear less valuable. This could discourage a company from buying back shares. Moreover, carrying debt becomes costlier as interest rates rise, so companies with significant debt might prefer to use their extra cash to pay down debt rather than buying back shares. They would be wise to do so. Therefore, rising interest rates can turn the tide for share buybacks, making them costlier and less attractive, and possibly leading to a decrease in buyback activity. One can only hope though. The following video also adds to this, as with rising interest rates, some companies with this debt can't afford to buy back shares, and if they do, well, the following can happen.
With interest rates rising, it will be much more expensive for companies to borrow money. Some firms could find themselves running out of cash while still needing to pay employees, vendors, and suppliers. That could create a cash crunch where companies have to sell off assets or declare bankruptcy. So when companies announce buybacks, some investors buy because it usually means the price will be rising. But some sell because it can also mean that the company is getting desperate and is more concerned with its stock price than with investing in the company itself.
So in a nutshell, while share buybacks might look good on the surface, they could be causing harm under the hood. The only group that sees the benefit to this are the suits, but is the risk worth taking with the state of inflation? Well, that's a question you'd have to ask them. I have no say in this. I kind of find it counterproductive, as in time, the lack of innovation and reinvestment into industries will halt growth in the long term. But I'm just a lowly YouTuber, so what do I know? So if you want to stay updated on all things related to the economy, geopolitics, technology, and Neopets, well, maybe not Neopets, then keep it locked to Profit Protection as we do our utmost best to simplify the complicated world surrounding these topics. And if you liked this video, then don't hesitate to like the video to show your support, and maybe subscribe to the channel for more videos like this one. In the meantime, you might also want to check out our video on how to identify undervalued stock. However, as for this video, that's all we have in store for you. I hope you found it informative, and I will catch you in the next one.